Welcome, curious minds, to another deep dive. Today, we're not just talking about tapping your phone to pay. We're really unpacking the quiet revolution of digital wallets. We've dug into some key insights from the Financial Conduct Authority, the FCA, and the Payment Systems Regulator, or PSR. Their recent feedback statement from February 2025, well, is quite revealing. It shows this explosive growth, sure, but also this intricate web of opportunities, hidden risks, and these regulatory battles shaping how we'll all pay very soon. Our mission today, cut through the jargon, give you a shortcut to understanding the powerful forces beneath the surface of this everyday convenience. What are the big benefits driving this shift? What surprising challenges are popping up? And, what does the future hold for your digital pocket? Okay, let's unpack this.
It's an incredibly timely deep dive. And what's particularly fascinating, I think, is the sheer pace of change. And the implications, they're pretty broad. For consumers, yes, but also the wider economy. We'll try to connect the dots between how these wallets actually work, how you're using them, and the really significant, sometimes quite contentious conversations happening among regulators about what comes next.
So let's start right at the core. When we say digital wallet, what are we actually talking about? And how are these seemingly simple tools, well, fundamentally reshaping our financial habits?
At its heart, a digital wallet is basically an app or a service. It's on your phone, maybe another device, and it lets you make payments. Usually it's linked to your existing debit or credit cards. But the key thing is you don't need the physical card with you. How? Well, it uses something called tokenization. Think of it like this, your real card number. It never actually leaves your device for the transaction. Instead, the wallet creates a unique, sort of single-use encrypted token, like a temporary digital alias.
Okay. Like a disposable key.
Exactly. A disposable key for one specific lock, not your master key. It drastically cuts the risk of your actual card details being stolen. And to prove it's you, they often use biometrics, fingerprint, facial recognition, that sort of thing.
That makes sense for security. But I've noticed they're doing much more than just payments now, right? What are some of the maybe surprising ways these wallets are evolving? Things listeners might not even think about yet.
You're absolutely right. They are evolving fast, becoming these comprehensive financial management hubs. So beyond just loyalty cards or tickets, they're tapping into open banking to show you real-time bank balances, transaction history. And looking ahead, we're talking AI-powered insights on your spending, maybe automated savings tools, or even identity verification, proving your age, professional licenses.
Right.
And further out, you hear talk about smart contracts for automating rent payments, escrow services, even managing digital assets like a potential CBDC, a central bank digital currency, or NFTs. It's a big shift.
A fundamental shift, really.
Yeah.
From just paying to being central to your digital life.
Precisely.
And it's not just the features changing. The adoption rates are just staggering. The data paints a picture of a financial revolution happening right now.
It absolutely does. Back in 2019, only, 8% of UK card transactions used a digital wallet?
Just 8%.
Fast forward to 2023, that jumped to 29%, over 9 billion transactions a year. And it's not just casual use. In 2023, about 20% of card users, they relied on a digital wallet for over half their card spending. And 10% use them for over 3/4 of their transactions. That shows a real dependency starting to build for some people.
So why are we adopting them so quickly? What's here for our habits?
Well, the immediate things are obvious. Convenience, security, quick tap to pay, no digging for cards or cash. Biometrics mean higher transaction limits than old contactless cards. Online, tokenization, dynamic codes, faster, safer checkouts.
But the so what?
It's more nuanced. It does subtly reduce the sort of psychological friction of spending, doesn't it? No physical cash leaving your hand. For some, that might mean less conscious spending. For others, though, those AI insights could actually boost financial literacy. It's a bit of a double-edged sword. And beyond that, stakeholders pointed to financial inclusion. International examples showed digital wallets really helping people in rural areas get access to financial services.
That evolution is truly remarkable. Which brings up a key question. How do these invisible transactions actually happen? And maybe more importantly, how do the companies behind them make money? Because we, the users, we rarely see a direct charge, do we?
It's a great question because, consumers generally aren't charged directly. But the business models, they vary quite a bit. We can sort of put them into two buckets, pass-through and staged wallets. Pass-through ones, think Apple Pay, Google Pay. They don't really hold your money. They just take your card details, tokenize them, and pass the payment request straight through to your bank or card issuer. They usually get a small cut, a commission from the card issuer for doing that.
Okay, so they're like a secure messenger. What about staged wallets then? Like PayPal, which most people know.
Exactly. PayPal's a good example. With staged wallets, you first load money into the wallet itself. It becomes e-money, essentially.
Like topping up a digital purse.
Precisely. Then the payment goes from your wallet balance to the recipient. These providers usually have direct deals with merchants and often charge fees to them, the merchants.
So different plumbing, but the tap often feels the same for the user. Okay, but how does my phone actually talk to the shop's terminal, that physical connection?
That's NFC technology, near-field communication. Think of it as a tiny, secure radio conversation between your phone and the terminal, just over a few centimeters. Now, how your payment details are handled within that process is important. There's host card emulation, or HCE. That's where payment details are mostly stored securely in the cloud, and your phone sort of pretends to be a card.
Right.
Then there's the secure element, or SE. That's like a tiny, super secure vault built right into your phone's hardware. The sensitive data stays locked inside the device itself.
And that distinction, HCE versus SE, that matters.
It matters a lot when we start talking about who controls access to that NFC communication, who holds the key to that vault, which leads us right into the big competition concerns.
Allah. Yes, the elephant in the room. This is where it gets really interesting and, frankly, a bit contentious. The source material highlights some pretty major concerns about competition, especially around the big tech players.
Indeed. A major point raised by almost everyone, banks, other payment providers, was Apple's historical restriction on its NFC chip access on iPhones. Until October 2024, basically only Apple Pay could use it for tap-to-pay.
Only Apple Pay.
Stakeholders argued this created huge barriers to entry for anyone else wanting to offer a competing wallet on iOS. It limited choice for iPhone users, effectively locking them into Apple's ecosystem for that function.
So the implication is pretty clear. A locked system can stifle the very innovation that could actually benefit users. Less pressure on Apple to add new features if there's no real alternative allowed.
Precisely that. Concerns were definitely raised that innovation was held back. Competitors said, look, we would have built wallets with, say, advanced financial insights, integrated banking features. Some even talked about creating centralized identity hubs for virtual IDs, health records, things like that. Opportunities missed, they argued.
And it wasn't just about blocking access, was it? There was the cost aspect, too.
Correct. Apple charges card issuers fees for their customers to use Apple Pay. Google Pay on Android generally doesn't charge issuers in the same way. Stakeholders suggested these fees might eat into the bank's ability to, well, reinvest in their own innovation or develop competing wallet solutions. It's a cost somewhere in the system.
But Apple has announced changes recently, haven't they? What's the latest there, and does it really fix these concerns?
They have made announcements. In August 2024, Apple said they intend to open up NFC access in the UK with iOS 18.1. This should allow third-party wallets to use the NFC chip and the secure element APIs. However, stakeholders still have pretty significant reservations, especially when you compare the UK offer to what Apple committed to in the EU after their investigation.
Could you break that down? What are the key differences between the UK and EU situation? That seems important.
It's crucial. Okay, first, in the EU, Apple committed to free access to the NFC chip. That's legally binding for 10 years.
10 years, legally binding, free, got it.
In the UK, they plan to charge for access. And the offer isn't legally binding or guaranteed for any set time.
So theoretically, the terms could change. More uncertainty for competitors.
Exactly. Second big difference. The UK offer gives access to the secure element, that on-device vault. The EU commitment focuses more on host card emulation, the cloud-based approach. Different technical routes. And third, unlike the EU, there are no equivalent binding commitments in the UK around other key iOS features. Things like letting users easily set a different wallet as their default, or letting new wallets use push notifications to prompt users. Little things that make a big difference in usability and competition.
So based on all that, it sounds like achieving a truly level playing field in the UK.
Right.
Well, it's still some way off.
That's certainly the view of many stakeholders, yes. Plus, these commitments, both UK and EU, they don't cover wearables, smartwatches, smart rings.
Right, so the competition issues could just shift to our wrists.
Potentially. Yes, that's a future concern.
And are these concerns really just about Apple? Or is there a wider issue with the dominance of the big mobile operating systems?
It's not entirely Apple-specific. Beyond the NFC issue, there's this broader point that both Apple and Google, just by controlling the mobile ecosystems,
Yeah.
Pre-installing their own wallets, the nudges, the notifications, they have a built-in advantage. They benefit hugely from network effects, global scale, strong brands. It makes it tough for anyone else to compete effectively, even when technical access like NFC is available, which we've seen on Android. It's about the whole user experience, not just one piece of tech.
Okay, moving beyond the competition between the wallet providers themselves, there are also these big questions about how digital wallets impact the underlying payment systems, and crucially, who's responsible if something goes wrong.
Absolutely key points. Right now, most of these pass-through wallets in the UK, they mainly run on existing card rails, Visa, MasterCards mostly. The concern is this could entrench the card scheme's position, make them even more dominant, and potentially act as a barrier to future alternatives.
Alternatives
Like account-to-account payments, A2A, using open banking, or maybe even a future digital pound. If wallets are hard-coded for cards, it makes it harder for these new methods to get traction.
So the worry is the current wallet structure could unintentionally block innovation in payments.
That's the argument. Stakeholders want wallets to be more flexible, integrate with different systems, let users choose their payment method per transaction, maybe see the fees involved. There are technical hurdles too, like the EMV standards for chip payments. They support card-based NFC, but not easily other methods right now. Some say those standards need opening up.
And what about the risks if we become too dependent on these wallets? I remember my bank's app went down once for a few hours, and it was surprisingly disruptive. What if a major wallet had a serious outage?
That's a critical operational resilience worry. If a major digital wallet fails, it could stop a huge number of people from making payments. Right now, most of us still have backup cards or cash, so the systemic risk is maybe limited. But as dependency grows, that risk definitely increases. Imagine a city's transport system heavily reliant on one wallet and it goes offline. Big disruption. And then there's fraud, unauthorized transactions. Wallets have strong security, biometrics, etc., which is good, but fraudsters adapt. They use sophisticated social engineering, clever phishing attacks, trying to trick you, the user, into giving up access or authorizing payments you shouldn't.
But if fraud does happen with a digital wallet payment,
Yeah.
who pays the customer back? Is it the wallet provider who authenticated it, or my bank?
And that is the crucial liability gap everyone's talking about. The digital wallet provider, they control the authentication, they check it's you, they okay the transaction. But under current rules, it's usually the underlying card issuer, your bank, who is ultimately responsible for security and has to reimburse you for unauthorized fraud.
So the wallet confirms the payment, but the bank takes the hit if it's fraudulent.
Largely, yes. And stakeholders argue this disconnect might mean wallet providers have less incentive to invest as heavily as they could in fraud prevention because they're not bearing the direct cost. Some are pushing for liability sharing models to fix this.
Okay, and one last risk. Could wallets actually end up excluding some people, even with all the talk of financial inclusion?
Yes, that's a definite concern. While they help some, there's a risk that if digital wallets become almost essential for payments, it could leave behind people without smartphones, or maybe those worried about data privacy, or just those who prefer not to use digital methods. Ensuring inclusive design, making sure people still have choices, that's really important.
So we've mapped out the amazing opportunities, but also these significant challenges. What are the regulators actually doing about all this? What's the plan?
Well, the FCA and PSR, they're working closely together. It's all part of the UK's bigger national payments vision.
Yeah.
They aren't planning huge, new, separate investigations themselves right now. Instead, they're coordinating with other key bodies who are taking the lead on specific pieces. The big one for competition is the Competition and Markets Authority, the CMA. They're really front and center now, especially with the new powers they got under the Digital Markets Competition and Consumers Act, the DMCCA, which kicked in January 2025. In fact, the CMA launched what are called strategic market status investigations into both Apple's and Google's mobile ecosystems back in January 25. We're expecting decisions by October 2025.
And what will those CMA investigations look at specifically?
They'll be looking right at things like NFC access, interoperability between services, and any rules that might unfairly block third-party services. So very relevant to our discussion.
So the CMA could be the one to really force changes here.
That's definitely the expectation. The DMCCA gives them significant teeth. Separately, the FCA is also talking to His Majesty's Treasury, HMT, as they review the existing payment services regulations and e-money regulations. A key thing they'll consider is whether to bring these pass-through digital wallets formally inside the FCA's regulatory fence.
To deal with.
To deal directly with those operational resilience issues, consumer protection standards, and especially that liability gap we talked about.
And what about future tech, like a digital pound? Where do wallets fit in there?
Oh, absolutely central. The Bank of England and HMT, as they explore a potential digital pound, see digital wallets playing a pivotal role. It's almost certain that's how you'd access and use it. And it's not just finance. Even the UK government is launching its own gov.uk digital wallet this year, 2025, for storing official documents like driving licenses. So the concept is becoming mainstream.
It seems like everyone's getting a wallet. Are other countries dealing with the same stuff, or is the UK on its own here?
Oh no, this is definitely a global conversation. The European Commission already tackled Apple's NFC control, leading to those binding commitments. Plus, they have the Digital Markets Act. You've got antitrust action bubbling up in the US. Australia's actively regulating. Japan just passed a Smartphone Software Competition Promotion Act. Everyone's grappling with it.
Which raises a question, doesn't it? If everyone takes a slightly different approach, what does that mean for wallet providers trying to operate internationally? Could it get messy?
It could. Fragmentation is a potential issue. But the overall context, look, it's clear. Digital wallets are here to stay. They're only going to become more central.
Yep.
The real aim of all this regulatory activity everywhere is to try and make sure this rapid change leads to genuinely better outcomes for us, the consumers, through more competition, more innovation, and crucially, strong protections.
What a journey. From just tapping your phone to, well, this intricate dance between big tech, banks, regulators. Digital wallets are clearly so much more than just convenient. We've seen the incredible growth, the ease they offer, but also these really complex challenges around competition, security, liability, and ultimately, who's in control.
It really highlights how innovation nearly always throws up new questions, doesn't it? And the regulatory world is constantly playing catch-up, trying to find that balance between encouraging the new stuff and keeping everyone safe.
So next time you tap your phone, maybe pause for a second. Think beyond the seamlessness. Consider the forces shaping its future. Where is your money actually held in that process? Who's making money from your tap? And who's responsible if it goes wrong? What stands out most to you about how these wallets are changing things? And if you could tell the regulators one thing to focus on for the future, what would it be? Something to think about. Thank you for joining us on this deep dive. We hope this has given you a useful shortcut to getting your head around this really crucial topic. Until next time, keep digging into the details.